Welcome to my Test Portfolio XSX YouTube channel. This video was created with the help of artificial intelligence. This is not financial advice. The video reflects my own opinion based on public data. Errors may occur. In this video, I will show how the past week unfolded on US stock markets, following the S&P 500, Dow Jones, Nasdaq Composite, and Russell 2000, and touching on the key daily events. I have prepared charts that show each index's year-to-date performance and the weekly changes from 28th April to 2nd May, using Friday's closes. First, I will briefly describe the daily moves, then turn to a weekly news wrap-up of events and headlines that affected the markets. Monday, 28th April, the market was choppy. Investors focused on US-China trade talk progress and escalating tariff war news. Dow Jones Industrial Average up 0.28% to 40,227.59. S&P 500 up 0.06% to 5,528.75. Nasdaq Composite down 0.10% to 17,366.13. Caution dominated. Many investors stayed on the sidelines. Tuesday, 29th April. Clear positive turn. Investors reacted to earnings and hopes of tariff cuts. Dow up 0.75%, S&P 500 up 0.58%, Nasdaq Composite up 0.55%. Some analysts called it a mini rally led by tech stocks. Wednesday, 30th April. Most volatile day. A mid-session GDP revision caused sharp swings. All three indices fell about 2% intraday. Markets partly rebounded by the close. Dow up 0.35%, S&P 500 up 0.15%, Nasdaq down 0.09%. The session showed the market's sensitivity to macro data. Thursday, 1st May, focus on big tech. Strong results from Microsoft and Meta lifted the sector. Dow up 0.2%, S&P 500 up 0.6%, Nasdaq Composite up 1.5%. Tech remained the market's chief driver. Friday, 2nd May, very positive mood. Non-farm payrolls. 177,000 new jobs signaled a stable labor market. US-China trade tensions appeared to ease. Indices closed strongly. Dow up 1.4%, S&P 500 up 1.5%, Nasdaq up 1.5%. This was the 9th straight-up day, a rare streak. Weekly summary: S&P 500 up 3.4%, Dow Jones up 2.9%, Nasdaq Composite up 3.2%. The biggest intraday swing came Wednesday when the unexpected GDP contraction sparked a brief sell-off that was quickly reversed. Weekly moves were driven not only by earnings and technical levels, but also by geopolitical and economic developments. Below are the key news items and data that influenced, or could have influenced, U.S. equities. Let's start with one of the most impactful topics: US-China trade tensions. 24th April 2025. Donald Trump told reporters that talks on tariffs took place today between US and Chinese officials. China's foreign ministry spokesman Guo Jiakun quickly replied, "At present, no consultations or negotiations are underway." 25th April. Beijing again denied any talks and accused Washington of misleading the public. 1st May. The state media channel Yuyuan Tantian reported that the United States had approached China through several back channels to discuss tariff relief. 2nd May. Beijing issued a statement. "We appreciate the U.S. offer to restart trade talks, but any future dialogue must be based on mutual respect and equality." The hesitant, sometimes contradictory messages kept uncertainty high, especially for export-oriented sectors and companies with China-exposed supply chains. U.S. macroeconomic data last week of April 2025. The data were mixed. The labor market stayed stable, while economic growth and manufacturing showed weakness. Non-farm payrolls. April saw 177,000 new jobs created in the United States. That is below March's figure, revised down to 185,000, but still signals stability. The unemployment rate held at 4.2%. Overall, the labor market is not collapsing, yet its momentum is fading. Weekly initial jobless claims. Seasonally adjusted initial claims rose to 241,000 for the week ending 26 April 2025, a two-month high. The increase suggests firms are turning more cautious on hiring. Continuing claims climbed to 1,916,000, a new three-year peak, a trend worth watching in coming months. ISM Manufacturing PMI. The April reading fell to 48.7, a second straight month below the 50 expansion line, signaling contraction. New orders, output, and employment sub-indices were particularly weak. Negative GDP reading, Q1. US GDP shrank at an annualized 0.3% rate in Q1 2025, the first decline since 2022. The drop was driven mainly by a 41.3% surge in imports, as companies front-loaded purchases ahead of new tariffs. Core PCE inflation. Core PCE, the Fed's preferred gauge, rose 2.6% year-over-year in March, matching expectations. Headline PCE was flat month-over-month, easing stagflation worries and supporting Friday's upbeat market mood. Supply chain and logistics responses to the new tariffs. Companies are reacting ever faster to Washington's latest tariff strategy. Many are front-loading shipments to avoid extra costs. Apple Air freight offensive. Apple Air shipped 600 tons of iPhones, roughly 1.5 million units, from India to the United States to dodge the 10% import duty. The firm has boosted Indian production capacity by 20%, introduced Sunday shifts, and created a green channel to speed customs clearance. These steps are part of Apple's diversification strategy against the Trump administration's 125% tariffs on goods from China. Automakers' preemptive export wave. Hyundai, Kia, and several German car makers including BMW and Mercedes sent early consignments so the vehicles would reach the United States before the 25% auto import tariff that took effect on 2 April. Shipping lines added extra capacity to ensure cars from Asian and European plants arrived on time. Automotive tariff impacts and corporate losses. Porsche, the German sports car maker, recorded at least €100 million in lost revenue during April-May because U.S. exports became more expensive. Volvo cars. Volvo shares fell more than 10% after the company announced a $1.8 billion cost-cut plan to restructure its U.S. operations. Jaguar Land Rover. JLR resumed exports to the U.S. after President Trump pledged to roll back part of the auto tariffs and grant retroactive refunds. Mercedes, Stellantis, Aston Martin, guidance withdrawn. Several European car makers, including Mercedes-Benz, Stellantis, and Aston Martin, withdrew their 2025 earnings guidance because the shifting tariff landscape makes long-term planning impossible. For example, Mercedes disclosed that Q1 EBIT fell 41%. European and Chinese sales dropped 10%. U.S. sales grew only 1%. Trump eases automotive tariffs, new order. On 29 April, the administration formally clarified that the 25% auto import duty introduced in early April does not stack with steel and aluminum tariffs, nor with separate auto parts duties. A retroactive rebate scheme was also created for U.S.-built vehicles. 3.75% of the duty can be reclaimed in the first year, 2.5% in the second year. The dual aim is to ease short-term financial pressure while encouraging domestic manufacturing and supplier networks. Port of Los Angeles. Traffic drop and warning. Executive Director Gene Soroka cautioned that Asian container traffic could fall by up to 35% in coming weeks because many U.S. retailers have paused Chinese imports amid tariff uncertainty. Roughly 45% of the port's throughput comes from China. A further 10% decline is forecast for the second half of 2025 unless a trade deal is reached. China quietly issues a tariff exemption whitelist. Reuters reported on 30th April that Beijing has introduced a whitelist of U.S. products exempt from the 125% retaliatory tariffs. Instead of a public announcement, provincial and city commerce bureaus sent private notices to affected companies. Items already covered include pharmaceutical intermediates, microchips, aircraft parts, and ethane. The U.S. is a major exporter. At the same time, Chinese authorities commissioned industry surveys, especially in semiconductors and textiles, to gauge the tariff war's impact. The results are not public. Chinese economic slowdown. Manufacturing PMI fell to 49.0 in April from 50.5, the lowest since December 2023, indicating contraction. Non-manufacturing PMI slipped to 50.4 from 50.8, still in expansion territory, but growth is clearly slowing. Beijing stabilization measures. Recent steps to protect jobs and shore up growth include employment subsidies to help new graduates find work, targeted corporate aid, financial support for SMEs to fund investment and operating costs, private sector protection law guaranteeing equal market access for state-owned and private firms, bank lending expansion. Commercial banks issued more than 3.64 trillion yuan, roughly $500 billion in new loans during March. Possible rate cuts. The PBOC signaled readiness to lower key rates if needed. Social contribution relief refunds or discounts on payroll levies for selected industries. Taken together, these moves show Beijing's effort to cushion the negative effects of the tariff war and the global slowdown while preserving domestic stability. Corporate layoffs and investor reactions. UPS will eliminate 20,000 jobs worldwide because parcel delivery volumes remain persistently weak. General Motors postponed its May Investor Day and withdrew its full-year guidance, citing trade uncertainty. Kraft Heinz, Electrolux and several other large firms cut their 2025 outlooks, saying tariffs and softening global consumer demand are hurting revenue. In the tech sector, we have Nvidia, Huawei, Meta Platforms, Microsoft, Apple, and Amazon. Nvidia. In April 2025, the US government placed H20 AI chips under an export license regime, effectively barring shipments to China. The company plans a $5.5 billion one-time charge in Q1 because those chips account for a large share of sales. Huawei and Chinese rivals, Huawei, Alibaba, Tencent, and others, have accelerated in-house AI chip programs. Huawei just unveiled the Ascend 910C GPU as an H20 substitute. Although China held more than 1 million H20 chips in inventory by late 2024, firms are pivoting to domestic designs for strategic self-sufficiency. Meta Platforms. Revenue for Q1 is $42.31 billion, with an EPS of $6.43. Shares rose 6% after hours, powered by strong ad revenue and fast-growing cloud AI services. Microsoft revenue for Q1 is $70.1 billion with an EPS of $3.46. Azure Cloud and AI offerings led growth, sending the stock up 7% post-earnings. Apple revenue for Q2 is $95.36 billion with an EPS of $1.65. New tariffs added $900 million in costs this quarter. The shares fell 3.7% after hours. Amazon revenue is $155.7 billion with AWS revenue at $29.3 billion, up 17% year-over-year. Slower AWS growth and subdued overall demand pushed the stock down 2% post-report. The tech sector is still enjoying robust AI and cloud-driven expansion, yet trade restrictions and global uncertainty are becoming significant cost headwinds. Amazon price hikes amid the tariff war. User reports and media stories indicate that prices for certain items on Amazon's marketplace have risen by 20% to 200% after the low-value duty-free threshold was abolished. A CBS News example showed a swimsuit that previously cost $119 ending up at $360 once duty and shipping were added. Amazon does not list tariff charges separately, but the company must pass its higher internal costs onto final list prices, because as a third-party platform, it cannot absorb the looming 145% Chinese import duty either. Foreign investors retreat from US markets. Reuters reports that several large European and Canadian asset managers, including major pension funds, have started trimming US equity and bond exposure because of America First policies and deteriorating profit prospects. US assets had reached a record 18% share of global portfolios, but many institutions are now cautiously scaling back. Many managers are rethinking their US allocation and diversifying toward other regions, an anonymous source told Reuters. Logitech production relocation. Logitech announced it will shift a significant portion of its Chinese manufacturing to other countries to mitigate the impact of the Trump administration's high protective tariffs. The plan includes expanding plants in Southeast Asia and Eastern Europe, adding Sunday shifts, and investing in automation to improve efficiency. Market reactions and outlook. The S&P 500 has risen for 9 consecutive sessions, posting a weekly gain of more than 10%, a rare show of strength. Analysts such as Jason Goepfert from Sentiment Trader and Mark Hackett from LPL Financial warn that short, intense winning streaks often precede bear market phases, suggesting a correction could follow the surge. The recent 0.3% GDP contraction, high volatility, and a flat to inverted yield curve all point to elevated risk in the weeks ahead. The trade war, geopolitical tensions, and monetary tightening create a backdrop where fundamentals weaken even as technical momentum persists. In the short term, the trend still looks upward, but over the next 6 to 12 months, a significant correction or sideways phase is likely until macroeconomic and political issues find firmer resolution. Bottom line, a powerful rally is underway, but risks are high. Investors should manage positions more cautiously and incorporate protective tools such as hedges and stop-loss orders. Chapter 3. My view of the current market. I am pessimistic because several interconnected factors are amplifying risk. 1. No substantive US-China deal. Despite conciliatory statements like "we value the offer," there is still no comprehensive trade agreement, and the cycle of denials keeps distrust alive. 2. Persistently unstable tariff war. Constant policy shifts make companies suspend or slow investment, undermining long-term planning. 3. Overvalued markets. The forward PE on the S&P 500 is above 23, while earnings estimates keep falling, a classic overpricing signal. 4. Risk of further monetary tightening. The Fed has not ruled it out, and parts of the yield curve have inverted, a frequent recession harbinger. 5. Geopolitical tensions. Trade war, the Russia-Ukraine conflict, Middle East flare-ups, and South China Sea pressure could all spark sudden market moves. 6. Weakening real economy indicators. GDP is down 0.3%, PMIs are below 50, consumer confidence is at multi-year lows, the economy looks vulnerable to another shock. 7. Corporate pessimism. Many large firms have withdrawn guidance or announced layoffs, feeding negative market psychology. This is not financial advice, but in my view, risk currently outweighs opportunity. Yield-seeking investors who prefer lower risk may find defensive strategies especially attractive. Chapter 4. How my fictional portfolio is shaping up. Now for a walkthrough of my fictional portfolio, in which I compare 3 different investment strategies. I plotted them in portfolio performance, so the returns are shown as percentages on a single chart. First investor, lump sum. On 2nd January 2025, this investor put a one-off $15,000 into an S&P 500 ETF. By Friday's close, the position is down 3.31%. For simplicity, I label the S&P 500 with a blue line. Second investor, dollar cost averaging. The full $15,000 is split across 12 months, investing $1,250 in the same ETF each month. Purchases take place on the second trading day of every month. If the market is closed that day, the order is executed on the next open day. As of Friday, the strategy shows minus 2.65%, plotted with a green line. My own fictional portfolio. As described in earlier videos, my first purchase was on 19th March 2025, using the same $15,000 starting amount. The red line shows where I stand at the latest Friday close minus 1.90%, with the entire account now in cash. Out of curiosity, I checked what would have happened had I not sold the stocks. The outcome would be much better, but this is the reality. These figures exclude broker fees, taxes, and so on. At the moment, there is little difference among the 3 strategies. In fact, it is surprising that the lump sum investor who dropped $15,000 into the market in early January 2025 and then never looked is sitting in roughly the same place as the dollar cost averaging investor, at least so far. And the sharp rebound over the past week has almost entirely erased the big lead my portfolio once had. Thank you for joining me in this detailed economics and portfolio video. I'd love to hear your thoughts. Which strategy do you find most convincing, and how do you see the market unfolding over the next few weeks? Let me know in the comments. If you found this analysis helpful, please like the video and subscribe to the Test Portfolio XSX channel. Don't forget to activate the little bell so you're always first to know about new content. Sources for the data and analyses shown in the video can be found in the description. Reuters, AP News, The Wall Street Journal, Financial Times, ISM, B.gov, Investopedia, CNBC. Thanks for watching and see you in the next episode. Adios.